Good morning, everybody. We're just going to give it another 30 seconds while people trickle into the call, then we'll kick off. All right. Good morning and welcome to our June webinar update. I'm Justin Ferraccio. I'm one of the two partners here at the firm. And this is Chuck Eberly,
Hey, good morning.
our founding partner and fearless leader. So we're going to kick off the way we always kick off. I'll do kind of a quick introduction, talk about the purpose of the call, and then we're going to dive into what we think is a pretty interesting topic today. Just as a reminder, this is not meant to be a replacement for specific questions to your situation. Please reach out to us directly. Um, Always feel free to invite friends, family, anybody you might feel would find this interesting, informative. Some people are just weird and love listening to financial updates. Invite them. So today we're gonna jump in. I'm gonna share the presentation. Please feel free to ask questions throughout the meeting. They come to me directly. They come through. No one else in the chat will see them. They're anonymous. They come to me. If they are appropriate for this conversation, Chuck and I will do our best to answer them. If they're more specific to your individual situation, we will reach out to you after the meeting and have a conversation. So I'll share my screen and we'll get going.
You know what we should do? I just learned that Dutton and Cash are on the call. Justin's two little boys, so we should say hi to Dutton and Cash.
Hey guys, they think that they're watching me on TV, so it's exciting for them. All right. Pay attention, boys. A lot to learn. All right. So, introduction, we'll do a quick market update where the stock market's gone over the past. We haven't done this webinar for about 6 weeks because we had some weird timing between months. But most of our time today, we're going to talk about the scale of AI spending, talking about the hyperscalers, CapEx, circular financing, which is a pretty interesting topic that Chuck will dig into. And then we'll do kind of conclusion and Q&A. And so a lot's kind of changed in the last 6 weeks since we've done this meeting. Markets have done extremely well. So at this point now, the Dow is up 7.5% in the year. S&P is up 10%. NASDAQ, which is more technology and AI focused, is up nearly 14%. The Russell 2000, which really looks at smaller cap and mid cap companies, so smaller than the S&P, NASDAQ, and Dow, that's raised a lot in the last 6 weeks. It's up 19% year to date. Equal weight S&P. So the S&P 500 above, it's all weighted by market cap. So it looks at, what the biggest companies in the world are and what their weight is to the index. So for example, Nvidia is nearly 8% of the S&P. So when they're doing weightings for the S&P, Nvidia has a bigger pool in that. The equal weight takes all 503 stocks in the S&P and weights them exactly the same. So it gives us a little bit more of a true reflection of what is happening in the broader market. It's not typical in an up market cycle like this to see the equal weight outperforming the S&P, but this is because, industrials are doing great, consumer discretion. So there's other sectors that are kind of outperforming a lot of tech right now, which we will spend a few minutes on. And then US ag, that's bonds. They're down 1% year to date. So the bond market continues to have a little bit of a challenging time. We have a Fed meeting today. And by we, I mean the Fed is meeting today, not me. They're going to talk. No action will happen today, but there should be some bullets that come out, whether they're hawkish or dovish, and kind of what direction we're going to see the rate market move here in the near future. So we're going to try to quantify the scale of AI investment, which is kind of a difficult task. So it's kind of no secret that AI has been driving the bull market for the past 3+ years. It's been It's been the major driving force. I think last call we talked about what's driving the market early part of this year, and that was earnings, right? So earnings were driving 2026. We, had one of the best earnings seasons on record in past several decades. So companies are doing well. They're compressing margin. They're doing the right things to be more profitable. But the real driving force behind the market, it's no secret, it's been AI. It will continue to be AI. And we're going to try to talk about the scale today. The total AI capital expenditure pipeline is now approaching 2.3 to 3 trillion. It is rivaling and beating the largest economic mobilizations in US history. And we have some charts where we can actually show you what that looks like. And I think that the message today is the risk is real. If AI investment slows or stops, in a worst case scenario, the consequences could mirror the early 2000s tech bust, pretty severe market and economic contraction. I think the important part of our message today is, uh, this because we kind of hammer this pretty often, is we're set up and we're ready for that to happen if it happens. I don't think it's the most likely scenario. I still think that, things are moving in the right direction. Economic indicators are great. We see this continuing into the future. But if the worst case were to unravel and AI investment were to slow or stop, just to put it in perspective, the S&P 500 is now 35% tech companies. But if you add back in communication companies like Google, Meta, and then some consumer discretionary, Amazon, Tesla, those are really AI adjacent companies. It's nearly 50% of the S&P are companies directly tied to AI investment. We own most of those companies. You all know that, but we own them at a much more controlled ownership level, right? So, our ownership of those companies might be, for most of you, closer to 15 to 20%, not 50, right? So if a contraction happens, if these companies slow down, we're not going to feel it anywhere near as bad as the market is going to feel it, is what we're projecting right now. It'll be kind of similar to what Chuck can talk about what happened, at SevenBridge in the early 2000s when we did have a problem with tech.
Yeah, we can talk about it now.
Before my time. Go ahead.
Just to, I think, this time right now resembles, the late 90s in a lot of ways with the new technology coming on. Most of the spending going on back then was, to get the fiber, to get the internet up and going. But in, late 90s, the S&P 500, in most portfolios were 60, 70% tech. So, some of the people on this call were clients of SevenBridge, or it wasn't called SevenBridge back then, but clients of the firm in the late 90s. The market was down 3 years in a row. We were down one of those 3 years. So, the strategy that we employ today is, the same as what we were using back then, investing by sector of the economy. And what we were doing is protecting against, something like this happening. So, we are prepared for it. We want to bring this up to you today so you can think about it. But, know that, we're looking for signs that this is starting to happen, and we'll go over that today.
All right. So now we're going to start talking about the actual, CapEx expenditures. And CapEx is, capital expenditures, right? So the hyperscalers are Google, Microsoft, Amazon. What am I missing? Meta.
Meta.
I would consider those kind of the hyperscalers right now. So in 2025, they spent $410 billion on capital improvements. So essentially building out infrastructure, trying to advance their AI capabilities. So they're spending an incredible amount of money to kind of try to be at the forefront of what's happening and capture, kind of be on the leading edge. 2026, we're projecting at 725 billion, capital expenditures. So 76% year over year growth in CapEx. The combined growth, combined spend over the last year and a half, 2 years is now nearing $1.2 trillion. We'll kind of put that in perspective here in a second. So who is spending the most money? It is Amazon, it's Microsoft, it's Google, it's Meta, and to a much lesser extent, it's Oracle. So again, what these companies are trying to accomplish is that they're trying to win this AI race and, be at the forefront, have the best AI companions, have the best data centers, and kind of be there when this thing starts to materialize, which it really hasn't yet in terms of being profitable for these companies, right? It's not profitable yet. It is an educated expense that they're making to try to become more profitable in the future.
If you think about it, the money they're spending is on capacity. So it's computing capacity, it's servers, it's chips, it's memory, it's power, um, data storage, water, all those things. So they're investing in that. They're trying to secure future capacity as well. So that's what all this money's being spent on. Is it me now?
It's supposed to be you now.
Oh, okay. So you look at private investments, OpenAI and Anthropic are the largest private companies, but if you see who's putting money into these, they're the same hyperscalers that we talked about. But you look at the sheer massive amounts of money being invested in just these two private companies. And there's talk about these two companies going public, which we'll talk about here in a second. But a significant amount of money raised in these two companies. Okay, the total AI pipeline. So we start to add up the pieces of this. You look at the hyperscalers, what they're investing, spending, the funding for the private AI companies. We just had one of these, SpaceX went public, so that one's, about 85 billion done, but now XAI, Anthropic, OpenAI, um, those will be, it's $250 billion or thereabouts. Future commitments, Stargate's a, public-private fund to build infrastructure, the data centers, that's, another 800 billion to $1 trillion. So you add that all up, it's 2.3 to 3 trillion dollars of investment. And what we'll look at next is how does that compare to previous projects? Um, you can see Stargate there, that's about a half a trillion. The Inflation Reduction Act, 900, stimulus package, another 831. One thing that, TARP back in at the financial crisis, that was 700. But you look at what it costs to build the interstate highway system, 600 billion, that's inflation adjusted. So the scale we're talking about is massive. You almost add up all of those other major investments or time of really time of change, things that really push things forward. They're all dwarfed by what's going on right now. It's you look at the Inflation Reduction Act, a lot of that money never got deployed. It was allocated but never deployed. So some of these projects, it's a big number, but the money never really got spent. This money's being spent. Um,
Yeah, I think it's important to note that 2.3 to 3 trillion is committed capital. It is not spent capital yet, right? So we'll talk about things we're watching in that space as well, but that is projected spend, projected committed. If that slows down, if, that committed capital is not deployed, that changes things, and we'll get into that next.
okay, something important to realize is that the money that's floating around out there, a lot of it is circular. So you look at, the first example, Amazon investing in Anthropic. So Amazon invests money in Anthropic, a private company, but along with that comes strings that Anthropic will buy services. In this case, $100 billion to Amazon over the next 10 years. So it's a contract. So yes, there's money being made, but it's in a circular way. So for the most part, these companies, these big hyperscalers have been paying for all this with cash flow. What we're seeing now is the spend is so much that it's outpacing their cash flow. Google, I think it was last week or the week before, $80 billion that, convertible bond.
Hmm.
So they're starting to see that, they don't have enough cash flow, so they're starting to borrow money. That's, to us, a sign that it's not sustainable. They just can't pay for it with cash flow. But something to watch out for. You look at Google invest 40 billion in Anthropic. There's another 200 billion committed to use the Google Cloud. And you can kind of see how these companies are aligning Amazon, Google with Anthropic, Microsoft and SoftBank and Oracle, with OpenAI. So there's kind of these different players that these hyperscalers are partnering with. But in each case, there's an investment and then a contract. So if any of these contracts would not be fulfilled, or just say, yeah, we thought we wanted it, now we don't, that's going to be a major warning sign. The other thing to think about is um, you look at our portfolio, a lot of the companies, like Caterpillar, John Deere, Cummins Engines, companies that you wouldn't think of as being AI are benefiting directly, and their earnings are coming from all this activity. So it's not to insulate ourselves. We can't just look at, the obvious. We got to kind of dig a layer deeper or a couple layers deeper of how far these tentacles go with all this money. Okay, so bottom line, key takeaways for us, for you, the bull markets, the engine is clear. It's AI, and that's where the bulk of the earnings are coming from. We got to look at, committed versus spent. Announcements are made, they're great, but they're not yet deployed. So one thing for us to all watch is seeing any of these committed capital spends that get delayed, they get canceled. That's going to be a warning sign. And we kind of talked about this, the downside scenario is, if you think about the game musical chairs, um, that, it's similar to that in a way, the music slowing down or the music stopping. What we got to look at is, signs that the music is starting to slow down. We want to be well prepared and not react to the music stopping. But music stopping would be similar to 2000. We don't think the music is stopping, but we think it's a risk worth talking about and thinking about and being prepared for.
Yeah. And our returns this year have been really, really strong. We're really proud of the results we've had the last many, many years, but specifically the last year, year and a half, year to date. Our risk-adjusted returns have been extremely strong. And I think we're proud of that. We're doing it with much less risk than the market. We talked about many of you have nearly half the tech exposure, AI exposure that the market has, and we're performing in a very strong way right now. So, like Chuck said, we're constantly preparing for things to not go according to plan, but at the same time, we need to participate when things are good, right? So we can't just sell because things might be, a little bit scary in the future. Things have been scary in the future for the last 10 years, right? And the rides continue to move forward. And we think that will continue to happen. But we thought this is a risk that we spend a lot of time talking about, and we thought you might find it interesting as well. So at this point, I'll stop sharing my screen. And if we have any questions, we can jump into those. Okay. Based on your past experience with the build out of the internet, any thoughts on how long this wave for AI will ride before hitting the shores?
Hmm. I don't know. I think if you think about the internet in the late 90s and you remember taking your phone and putting it in the cradle and getting, the handshake, the digital handshake, and how slow everything was, and just how amazed we were that you could send an email or you could look up stuff from, from the encyclopedia. Um, and where we are today with the internet, it keeps evolving. But now it's part of our lives, with cell phones, with the internet, and it created a lot of productivity, a lot of profits. It creates a lot of problems, and I don't think there's any way for us to know what AI is going to look like. It's almost to me the internet on steroids. So if you use, any of the, ChatGPT or Grok or any of these other ones, it's pretty much, it's a much better way to use the internet, much more efficient, easier, more complete, detailed, saves you time. Um, but I think we all kind of didn't trust the internet, the answers that are on there. Now that AI's part of it, it seems like people are more out to, use it and believe it. So there's a long way to go with it. I, I, I don't know how long it's going to take. If you take previous, the telephone or TVs, it takes 10, 20 years. You think back to the internet, there's a lot of good things that happen along the way until it's fully implemented. But
Yeah, I think we talk about it as, baseball game, right? And with AI, we're probably still in the first inning, in the first half of the first inning, maybe the first out, right? It's truly impossible to project forward where it's going to go, what it's going to look like. The same as the internet was when we were, plugging in your modem and having dial-up internet. Very, very few people would have projected that, we at some point have a computer in our pocket that was more powerful than any personal computer in the history of the world, right? So things progress, and with AI, they will probably progress more quickly. It's just kind of the nature of the industry. But like Chuck said, it still has a lot of legs. There's a long way to go. It may have corrections along the way. Certain companies may fall out. The hyperscalers are very, very likely safe in this whole thing just because they have so much revenue and they're so large at this point. But some of these smaller AI companies, they just won't all make it.
yeah, it's hard to figure out. You look back at the early days of the internet, Yahoo and AOL, and you know, some of you remember, some of the internet names, E-Tech, and there was a lot of big companies that didn't make it out of that, and companies you would have thought would have never failed, but they have. You look at Cisco. Cisco, I don't think has reached the highs that they made in early 2000. They've never gotten back to those highs. So, I think it's exciting. We want to participate in it. So we don't bring this up to say, hey, we're stepping back and we're going to sit in cash or, lock in lousy returns because this concern is out there. It's more, it's something that we have to think about, be prepared for, but it doesn't mean that we want, to sit back and not have your money work for you. We want to continue to have your money work, continue to have good returns, but be prepared.
Okay, we got one more question. This one would be good for you. Is healthcare an AI alternative? The industry seems to be dragging. This might be a good garden example for you.
Yeah. We were just talking about this morning, what do we do to help alleviate the risk? And yeah, I think there's a lot of use cases within healthcare. Healthcare has been a horrible performing sector that, this year and, most of last year. So I think that's what we need to continue to do, which we will, is to stay diversified by sector, even though, we're not overjoyed by the returns of healthcare. It doesn't mean we leave it, because if we get trouble in the with the spend, other sectors will pick it up. But I think there's so many use cases with healthcare. You just look at reading breast cancer screening exams and dermatology and, just everything, I think there's so many use cases for AI that we just can't imagine, um, how far it goes. And I think healthcare is a huge opportunity for AI. But right now, it's hard to figure out how they're going to make money on it. And it appears right now, looking at the stock performance, that they aren't. But
Yeah.
maybe that's a place where the puck's going.
It is part of the strategy too. We can't have every, sectors of the economy, some correlate together, some don't correlate. Healthcare traditionally doesn't correlate with technology, communications, things like that, right? So Chuck often talks about this as a garden. There's, many different sectors of the economy that we're investing in. They don't all bloom at the same time, right? We have certain things bloom. And, look back 2 years ago, financial services were terrible. We had a lot of conversations about people wanting to move away from financial services. Last year, companies like Goldman, JP Morgan, Morgan Stanley were up 50 to 70% in 1 year, right? So we have to stay patient, stay the course, stick with the strategy. And we know at some point healthcare will turn around and bloom, and we'll be able to start making money there again. It'll likely be when other sectors of the economy turn the other way. So it's a ballast system.
It's dormant, not dead.
Nice. All right. Well, we've kept you for half an hour. We really appreciate everyone that's joined the call. And please reach out to us with any direct questions and look forward to seeing you all in July.
Yep. Hope to talk to you all soon.
Bye.
Have a good day.